If you live in the United States, the dollar feels normal. It's your paycheck, your savings, your coffee money. But in much of the world, the dollar is not just money. It's a gatekeeper. In Africa, entire economies rise or fall based on access to a currency that isn't printed there, regulated there, or politically accountable to the people using it. And here's the uncomfortable truth. This isn't just an African story. It's a glimpse into how the global money system really works. When you don't control the currency you depend on. This is the dollar problem no one talks about. The US dollar is often described as America's currency. That's misleading. In reality, the dollar is the world's settlement currency. Over 80% of global trade touches the dollar at some point. Oil is priced in dollars. Aircraft leases are paid in dollars. Global debt? Mostly denominated in dollars. Now here's where Africa enters the picture. Many African countries export raw materials, oil, cocoa, copper, lithium, but import refined goods, machinery, fuel, medicine. Those imports are priced in dollars. So even when two African countries trade with each other, the transaction often passes through the US dollar first. This isn't just inefficient. It's structurally dependent. And dependency has consequences. Let's talk about something most people never see: correspondent banking. If a bank in Kenya wants to send dollars to a bank in Germany, it usually can't do it directly. It needs a correspondent bank, typically in New York or London, that holds dollar accounts on its behalf. This is how global money actually moves, through a small number of powerful financial choke points. These banks must comply with US AML laws, anti-money laundering, KYC rules, know your customer, sanctions regimes. Regulatory expectations set far from Africa. If a correspondent bank decides the risk is too high, it can simply cut the connection. No court case. No vote. Just disconnection. This is called the risking. And Africa experiences it more than almost any region in the world. This isn't just an African story. It's how financial power quietly enforces itself globally. Here's a paradox. When the US Federal Reserve raises interest rates to fight inflation at home, it strengthens the dollar. That's good for American savers. But for African economies? It's devastating. Why? Because many African governments borrow in dollars. When the dollar strengthens, debt repayments become more expensive. Imports cost more. Local currencies weaken. Inflation accelerates. Suddenly, a country hasn't changed its policies at all, but its financial position collapses. This is how external monetary policy becomes internal pain. In the US, rate hikes are debated on television. In Africa, they show up as higher fuel prices, medicine shortages, currency controls, IMF emergency negotiations. This isn't mismanagement alone. It's exposure to a system you don't control. When dollars become scarce, markets don't stop. They adapt. In many African countries, official exchange rates exist, but so do parallel markets. People trade dollars informally, on messaging apps, through street dealers, via offshore accounts. This isn't because people want to break the law. It's because the system makes legal access impossible. Businesses need dollars to import goods. Students need dollars to pay foreign tuition. Families need dollars for medical care abroad. So when the formal system fails, an informal one replaces it. This isn't chaos. It's a rational response to scarcity. And similar dynamics appear everywhere, from Argentina to Lebanon to Eastern Europe. This isn't just an African story. It's what happens when hard currency meets weak access. Many people believed fintech would solve this. Mobile money, digital wallets, crypto rails, and fintech did change access. But it didn't remove the dollar's dominance. In fact, it revealed something important. No matter how modern the app looks, most fintech systems still settle in dollars somewhere in the background. Visa, MasterCard, SWIFT, U.S. correspondent banks. Even stablecoins are often backed by U.S. treasuries. So fintech didn't escape the dollar system. It made the dependency visible. When a fintech app is frozen in Africa, it's often because a dollar link trail was disrupted upstream. This isn't a tech failure. It's a monetary architecture issue. The dollar system is often described as neutral. It isn't. It rewards countries that issue reserve currencies, institutions closest to settlement layers, banks deemed low risk by global regulators. It penalizes frontier markets, informal workers, small exporters, entire populations with no say in monetary decisions. And yet, African economies keep participating. Not because they want to. Because opting out means isolation. This is the real dollar problem, There is no alternative that works at scale, yet Africa is not a special case. It's an early warning system. What happens here shows us what the global money system looks like under stress. Dollar dominance brings stability, but also fragility. Efficiency, but also exclusion. This isn't just an African story. It's a preview of how power operates in global finance when access, not innovation, becomes the real currency. And the question the world hasn't answered yet is simple: what happens when too many people need a dollar they don't control?